The BRICS currency was supposed to be inevitable. It was talked about like a countdown timer, like the dollar's replacement was already printed and just waiting behind a curtain, and yet it keeps not arriving, not postponed by a meeting, not delayed by a press conference, not held up by paperwork, blocked by something deeper, something that should have been in the news every time it happened, because it exposes the whole misunderstanding. Countries have already settled real trade outside the dollar, and the dollar still didn't collapse. So why does the internet keep insisting a new BRICS currency is about to end everything, when the world has already tested parts of the story and nothing dramatic happened? Because most people are chasing the wrong object. They think a currency is a piece of paper. They think power is the label on the paper, but the real world runs on something else. Collateral, trust, exit doors, and the ability to move size in a crisis without asking permission. If you stay with me, you are going to get the test that makes this whole debate stop feeling mystical. You will know what would have to exist for a BRICS currency to become more than a slogan. You will know what BRICS is actually building that matters more than a shared currency. And you will know how that changes the map for stocks, banks, exchanges, energy, and the kinds of assets that get treated like lifeboats when the world gets nervous. And I am also going to give you the part people really want, the answer to the question. They keep screaming without realizing what they are asking. If BRICS can't launch a real rival currency soon, who benefits from that delay? Because yes, there are winners. You did that. You lived inside a world where one system handled most of the settlement, most of the collateral, most of the emergency exit. You saved simplicity. You saved cheap hedging. You saved smoother global trade. You saved a lot of invisible friction you never had to think about. But you paid for it too. You paid with dependence on one set of rails and one dominant pool of assets. So when people hear BRICS currency, they hear freedom from that dependence. They hear the end of the toll road, and they want to believe it because dependence feels scary. But the world does not change because we want it to. It changes when the alternatives can carry the weight. If you valued this kind of long-form breakdown where we turn loud claims into clear mechanics, hit like, subscribe, and share this with a friend who swears the BRICS currency will kill the dollar next year and a friend who thinks the whole thing is a joke, because both of them are missing what is actually changing. Now let us start with the mystery that makes people uncomfortable. Why is it so easy to imagine a new currency and so hard to build a real reserve currency? Because a normal currency is like a ticket. A reserve currency is like the entire stadium. A ticket is a unit you can hand someone for a transaction. A stadium is the infrastructure that makes millions of people show up, buy, sell, borrow, lend, hedge, and exit under pressure without chaos. Printing a unit is easy. Building the stadium is brutally hard. And if you only look at the ticket, you will keep getting fooled. You will keep thinking the announcement equals the reality. You will keep thinking the label equals the power. So what does a reserve currency really mean in practice? It means central banks, sovereign funds, corporations, and global banks choose to hold large amounts of assets in that currency because they trust the rules. Around it, they trust the liquidity, they trust the legal predictability, and they trust that when the world panics, they will not be trapped. That last part is the part everyone tries to skip. Because the real test of a reserve currency is not a calm day. It is a crisis day. In a crisis day, you need to sell size. You need collateral that everyone accepts. You need hedges that actually work. You need a market deep enough that your exit doesn't become the headline. That is why this entire argument keeps going in circles. People argue about whether BRICS can create a currency unit. Of course, they can create a unit. The unit is not the hard part. The hard part is the pile behind the unit. And this is the prize you came for, but you cannot use it until you understand what it really is. A reserve currency is not crowned by speeches. It is crowned by a gigantic, trusted, liquid, investable pool of assets that the world can hold without fear. That is why the dollar is not just green paper. The dollar's real engine is the ecosystem of dollar assets, especially the deep market for US government debt that functions as the world's most used collateral. People love to mock government debt. They treat it like a shameful thing. But in the plumbing of finance, it is a tool. It is a universal adapter. It is the thing that makes short-term funding work, makes hedging work, makes portfolios liquid, makes margins function, makes banks comfortable. You did that. You laughed at debt headlines, but you benefited from the debt market being so deep and so liquid that the world uses it like oxygen. You saved convenience. You paid with exposure to the credibility of that system. Now, bring this back to BRICS. For a BRICS currency to matter, like a reserve currency, you would need a comparable pile of trusted assets in that currency that global holders actually want to own in size, not as a political statement, as a place to park serious money, as collateral that institutions accept as something you can liquidate and stress. And here is the problem. BRICS is not a single country with a single fiscal authority and a single central bank and a single legal framework. It is a coalition of countries with different inflation histories, different political incentives, different capital controls, different sanctions, exposures, and different ideas about what financial openness should look like. So even if they agree on a unit, what sits behind it, whose bonds become the trusted collateral, whose courts enforce the rules, whose central bank backstops liquidity, who eats the loss if something breaks. That is where the stadium construction begins. And that is where the stadium construction keeps failing, because you cannot build a reserve currency on vibes. You cannot build it on resentment. You cannot build it on a logo. You have to build it on assets and trust and openness. And openness is expensive, because openness means you accept capital coming in and going out without panicking. It means you accept that markets can punish you. It means you accept constraints. Most countries do not want that. They want the power of a reserve currency without the vulnerability of being tested. They want to be the stadium without letting the crowd run. Now let us deal with the comparison that keeps breaking people's brains. People think BRICS can copy the euro. They think a shared currency is a template. But the euro was built on deep political institutions, shared rules, shared constraints, and an architecture that took decades of integration to become credible. And even then it went through crises that almost tore it apart. BRICS is not that kind of union. BRICS is closer to a trade and political alignment story than a single integrated sovereign structure. A shared currency without shared discipline turns into an argument machine, because everyone wants the benefits and nobody wants the costs. That is why the BRICS currency story keeps going viral but keeps not becoming real. Now here is where we pivot into what matters. The part that will surprise people who came only for the currency drama. BRICS does not need a shared currency to weaken the dollar's monopoly power at the margins. Because the dollar's power is not only about what you call the unit, it is about the toll road. And BRICS can build bypasses, not by replacing the dollar everywhere, but by creating alternative ways to settle certain trade corridors without always touching the same rails. That is why the real story is not a new BRICS bank. The real story is payments plumbing, messaging systems, interoperability, local currency settlement habits, bilateral swap lines, regional systems that make it easier for a trade to clear without routing through the same central hub. And this is where you get another ledger beat. You saved simplicity by living in a world with one dominant highway. You paid for it by making that highway a single point of vulnerability for anyone who could be cut off. So now a lot of countries are trying to buy back redundancy. Redundancy's not free. Redundancy is not efficient. Redundancy is what you buy when you fear being locked out. That is why this whole de-dollarization story is misunderstood. It is not a divorce. It is a second set of keys, a second door. A spare generator. You do not install a backup generator because you want the grid to die. You install it because you cannot afford to be powerless if the grid fails. That is what payment plumbing projects are. And once you see it that way, the BRICS currency story stops looking like a countdown and starts looking like infrastructure. Infrastructure moves slowly, then suddenly feels obvious. Now, I promised you the test that ends the common wars. The test that tells whether a new currency is real or cut. But before you can apply the test, you have to stop confusing pricing with funding. Pricing is what you put on the invoice. Funding is the currency you borrow in, hedge in, hold reserves in, and use as collateral. Pricing is the sticker on the box. Funding is the warehouse that stores everything. You can print a new sticker overnight. You cannot move the warehouse overnight. So when you hear a headline about trade settling in a non-dollar currency, the question is not whether that trade happened. The question is whether the warehouse moved. Did the participants start holding assets in that currency in size? Did they start borrowing in it? Did hedging markets deepen around it? Did the currency become freely usable and freely exitable in stress? Because if the answer is no, you are watching a corridor bypass not a reserve to Now we can talk about winners and losers, because this is where people actually care. If the BRICS shared currency stays mostly a headline and the world remains largely dollar-centered, the incumbents keep collecting tolls. The biggest beneficiaries are the institutions that sit on the dollar highway. Exchanges that dominate commodity and rate hedging and the plumbing of derivatives, like CME Group and Intercontinental Exchange, benefit from the dollar system stay in the main arena where risk gets priced and transferred. Global banks with deep FX and commodity desks, like JP Morgan Citi, Goldman Sachs, and internationally HSBC and Standard Chartered, benefit from being the mechanics of cross-border finance, providing hedges, trade finance, clearing, custody, and credit. The large integrated energy companies like ExxonMobil and Chevron and global majors like Shell and Total Energy benefit from standardized settlement and the ability to hedge and finance in the deepest pools with less corridor friction. And the quiet winner many people forget is the US itself. Because when the world parks in dollar assets, it supports the depth and liquidity that keeps the system dominant. Now, flip the scenario. If BRICS plumbing succeeds in building real corridor bypasses, even without a shared currency, you can still get meaningful change. You can get more local currency settlement in certain trade lanes. You can get less automatic routing through dollar rails. You can get more FX hedging demand because companies now carry more currency mismatch. You can get more complexity in trade finance. Complexity has winners. Sophisticated intermediaries can profit from it. Commodity trading and marketing businesses thrive on basis risk and flow complexity, which is why firms like Glencore often get discussed as beneficiaries of a more complex commodity world. And the hidden beneficiaries are the picks and shovels of volatility, the firms that monetize hedging volume, clearing volume, and risk transfer. But complexity also has losers. Smaller companies with weak treasury management get punished harder. Emerging markets with fragile external financing can see more volatility, and consumers pay because higher friction in settlement and hedging often shows up as higher costs in the real economy. So here's another ledger beat. You saved efficiency under a single dominant system. You paid with fragility and political vulnerability for those outside the core. In a fragmented system, some countries save autonomy. They pay with friction. The world does not get a free lunch. It chooses which cost it prefers. Now, you might be thinking, okay, if BRICS is building bypasses, does that weaken the dollar or not? Here is the honest answer. It can weaken the dollar's monopoly power in certain corridors without replacing the dollar globally. It can reduce the dollar's unavoidable role for specific participants. It can change bargaining power. It can change how sanctions and enforcement feel. And that matters even if the dollar remains the main language of global liquidity. This is why simplistic narratives fail. The dollar can remain dominant and still face more competition at the edges. The edges matter because edges are where crises start, where shortages show up, where politics bites. Now, we are right at the edge of the prize. You want the scoreboard? You want the set of signals that tells you whether BRICS is building something real or just feeding the meme machine. In the next part, I am going to lay that scoreboard out in plain language. And then I am going to walk through what it means for the assets people actually own. How this changes the way you think about the dollar, about gold, about energy stocks, about exchanges, about global banks, and about the kind of portfolio behavior that survives a world that is becoming less centralized. If this is already clarifying things for you, hit like, subscribe, and share it with a friend who thinks a BRICS press release can replace a reserve system. Because the fastest way to stay safe is to understand what is actually hard to build. Now, let us put the scoreboard on the table. Because once you see the scoreboard, the BRICS currency argument stops being emotional and starts being measurable. A real reserve currency is not proven by an announcement. It is proven by what happens when serious money tries to park, hedge, borrow, and escape in size. So here's the first scoreboard line, and it is the line that breaks most dreams. How big is the asset pile behind the currency? The world's official foreign exchange reserves are about $13.0 trillion. In the most recent snapshot, about 56.9% of those reserves are held in dollars. Run that number, and it stops being a debate and becomes a weight. 56.9% of 13.0 trillion is about $7.4 trillion parked in dollar assets. That is the parking lot. The euro is about 20.3%, which is about 2.6 trillion. And the renminbi is about 1.9%, which is about 0.25 trillion. So when someone tells you a BRICS currency is about to replace the dollar, ask them to look at the parking lot and not the press conference. $250 billion in reserves is not nothing, but compared to 7.4 trillion, it is not a challenger. It is a side lane. You did it. You lived inside a world where one parking lot held the majority of global emergency savings. You saved the comfort of knowing there was always a giant place to park. You've paid for it by making that parking lot the center of gravity for everybody's fear. Now, the second scoreboard line, how liquid is the world's actual money-moving system? The foreign exchange market trades about $7.5 trillion per day. Per day. That's it. Global reserves are about 13.0 trillion. That means the world trades an amount in one day that is more than half of the entire reserve stockpile. It is like watching a city where the daily traffic is larger than the number of cars owned in the whole country. In that environment, liquidity is not a slogan. Liquidity is survival. And the reason the dollar remains dominant is because in a crisis, liquidity is the exit door. People do not hold a reserve currency because it is cute. They hold it because when the building fills with smoke, they want a door that opens. Now, the third scoreboard line, convertibility. Can you get in and out freely? Can you move size without capital controls trapping you? Can you rely on the rules not changing when pressure rises? This is where a lot of currency dreams fail quietly, because the world does not just want a currency unit. The world wants a currency that behaves like a public highway, not a private driveway with a gate that can close when the owner panics. A reserve currency requires a level of openness that many countries do not want to grant, because openness is a two-edged sword. It brings capital in, but it also lets capital leave. You did that. You saved the sense of national control by liking the idea of capital controls. You paid for it by making outsiders reluctant to store their life savings in your system. Now, the fourth scoreboard line, hedging depth. This is the part that decides whether the stadium is real. In oil, in commodities, in corporate funding, in global trade. People do not just need a currency to pay. They need derivatives to hedge the risk of holding that currency. They need tight spreads. They need reliable market makers. They need clearing depth. They need the ability to manage risk without paying a massive friction tax. If the hedging pools are shallow, the currency cannot carry the weight. It is like building a bridge that looks strong from far away. Then you drive a truck onto it and it starts shaking. Now the fifth scoreboard line, stress performance. This is the ultimate test. When volatility hits, do participants stay in the new system or do they run back $2? Because a reserve currency is not a popularity contest. It is a crises habit. If the habit is to run back to the dollar, the moment things get ugly, the dollar remains the center, even if experiments grow on the edges. Now here is the part that makes people mad, because it sounds like I am saying nothing will ever change. No, plenty is changing, just not the way the viral story sells it. The viral story says BRICS will flip a switch and create a new currency that ends the dollar. The real story is BRICS and other countries building bypass lanes. Not one new stadium, more roads, more interoperability, more local currency settlement in specific corridors, more redundancies, so fewer countries are trapped by one toll road. That is de-dollarization in the real world, not a divorce. A second set of keys, and redundancy changes bargaining power, even if the main system remains the largest. Now, let me show you why the shared currency meme keeps failing, because every shared currency proposal runs into a simple question. Who provides the safe asset? In the dollar world, the giant collateral pool is U.S. Treasuries. The U.S. Treasury market is enormous. Marketable Treasury debt outstanding recently pushed above about $30 trillion. That is the engine room, and total U.S. federal debt is around $38 trillion. You can hate that number and still understand what it creates, a massive stock of widely used collateral. In fiscal year 2025, the U.S. deficit was about $1.8 trillion. That is roughly 5.9% of GDP. People hear deficit and assume weakness, but the machine effect is more complicated. Deficits create issuance. Issuance creates supply of collateral. Supply of collateral feeds the system's plumbing. It is like a city that keeps building more parking garages and more roads. The city's debt rises, yes, But the city also becomes the place everyone can move through when the weather turns bad. You did that. You saved convenience because the world had a giant pile of collateral to use. You paid for it with a future cost, because interest expense and debt sustainability become bigger political issues over time. Now, compare the scale problem for a BRICS currency. If you want a reserve currency, you need an asset pile that outsiders can hold in size with confidence. Not just inside the block, outside the block. Because reserve currency status is not self-awarded. It is granted by other people choosing to hold your stuff, and right now, the numbers show how far that is. In reserves, the renminbi is around 1.9%. In global payments, by value, it has recently been around 2.9% and sits around 6th place. That tells you something important. Use is rising in some lanes, but it is still small relative to the dominant system. So the shared currency promise keeps crashing into the same wall. It is not about printing a new unit. It is about building a trusted, liquid, open, investable ecosystem behind it with crisis-tested exit doors. And that is why the most realistic near-term outcome is not a single BRICS currency replacing the dollar. It is a world where corridor by corridor settlement becomes more mixed. Some trade clears in local currencies when it is convenient or politically safer. Some trade stays in dollars because liquidity is unbeatable. Some corridors build their own habits. That creates a world that feels less centralized, more fragmented, more expensive, and more volatile. Now let us bring it to your money, because if you cannot translate the scoreboard into real decisions, it is just entertainment. The first decision is psychological. Stop building a plan that depends on one dramatic switch, because the world rarely gives you a clean switch. It gives you a slow grind interrupted by sudden shocks. If your plan requires the dollar to collapse next year, you are putting your life on a calendar that does not care about your rent. The second decision is structural. Build optionality. That means avoid leverage that can force you out during volatility. It means keep liquidity so you can act when others are trapped. It means diversify so one regime shift does not ruin you. And it means you focus on quality balance sheets and pricing power. Because in fragmented worlds, weak companies get squeezed harder by higher funding costs and higher hedging costs. Now, the third decision is where people actually want names, because names make it real. In a world where the dollar stays dominant, the toll collectors on the dollar highway keep their advantage. Market infrastructure that monetizes hedging volume can benefit from ongoing dollar-centered risk transfer. CME Group and Intercontinental Exchange sit in the risk plumbing layer when the world hedges rates, currencies, energy, and commodities in deep markets. That infrastructure stays busy. Large global banks with deep cross-border and FX capabilities can continue to benefit from being the mechanics of settlement and hedging. JP Morgan Citi, Goldman Sachs, HSBC, Standard Chartered, they live on complexity and flow, and the dominant system generates a lot of flow. Integrated energy majors like ExxonMobil, Chevron, Shell, Total Energies benefit from standardized settlement and deep hedging pools because it lowers friction across global operations. Now flip to a world where fragmentation grows at the edges. You still do not get an instant dollar replacement. What you get is more currency mismatch, more quarter complexity, more hedging demand, more operational friction, and that friction has business models attached to it. Cross-border friction creates room for specialists who monetize international payments. Pain, likewise. Volatility and hedging demand can support the infrastructure layer again, because more corridors means more basis risk and more demand to manage it. Commodity intermediaries can benefit from a world where routing and financing are less smooth, because complexity creates spreads. That is why you often see firms like Glencore discussed in the context of commodity complexity, even though every company has its own risks and cycles. Payments networks like Visa and MasterCard sit in a different layer, mostly consumer and enterprise payments, but they still live in a world where currency dominance and cross-border volume shape the environment. If fragmentation increases, compliance and routing complexity rises, and the winners tend to be the networks that can maintain trust and scale while adapting to new rules. And then there is the parallel rail everyone argues about, crypto rails and stablecoin rails. Not as a replacement for the entire system, but as a tool that grows where traditional rails are expensive, slow, or restricted. If that grows, picks and shovels infrastructure names like Coinbase can matter as regulated gateways again with their own risks and cycles. Now let me bring you back to the most important reality check, because this is the part that keeps you from getting fooled. Even if the world slowly diversifies away from the dollar at the margins, the dollar can still spike in crash, because network effects do not die quietly. They defend themselves through fear. And fear makes people run to the deepest pool. So you can live in a world where the $S reserve share drifts from 57% to 56%, while the dollar still strengthens when markets panic. That is not a contradiction. That is the system behaving like a system. Now, here is the prize answer, stated cleanly. The BRICS currency keeps failing because the world does not need a new unit. The world needs a new asset pile, new hedging depth, new openness, and new crisis-tested exit doors. That is why you get speeches about a currency in construction, in payments, plumbing. Because plumbing is achievable without surrendering national control. A shared reserve currency is not achievable without surrendering a lot more. So if you want to stop being whiplashed by the headlines, you watch 3 numbers and you watch their direction over time. The reserve share number, right now, the dollar is still around the high 50% range of reserves, and the euro is around the low 20% range, and the renminbi is still around the low single digits. The payments share number, right now, the renminbi is still a small slice of global payments by value in the low single digits. The collateral pile number, right now, the US Treasury market is still measured in tens of trillions. With foreigners holding around 9.25 trillion of treasuries, which is about 30% of the publicly held debt stock, around 30.8 trillion. Those numbers are the gravity that is the stadium. That is what a press release is trying to compete with. You saved yourself the work of tracking these dials by believing a simple story. You paid for it by letting loud narratives rent space in your head. So here's what other people do. The people who cannot afford to be wrong in a dramatic way, they treat the transition as uneven. They build redundancy. They manage currency mismatches. They keep liquidity. They avoid being forced sellers. They diversify across real assets and productive assets. They plan for volatility because in a fragmented world, the tax you pay is instability. And the way you survive instability is not by predicting perfectly. It is by staying flexible when other people get trapped. If this helped, hit like and subscribe. Share it with one friend who is waiting for the BRICS currency like a movie release date, and one friend who thinks none of this matters, because both of them are ignoring the same truth. The world is not flipping a switch. The world is laying new pipes. And pipes change the flow even when the old pipe still carries most of the water. Now, I want the comments. If BRICS never launches a shared currency, is that a failure or is that the point? What single number would convince you a BRICS currency is real? Is it a reserve share crossing 10%? Is it a payments share crossing 10%? Is it a new asset pile measured in the tens of trillions with deep hedging markets? And if you had to choose, would you rather live in one global system or multiple regional systems, and why? Because that answer tells you whether you prefer efficiency or autonomy, and the world is in the middle of choosing, corridor by corridor, pipe by pipe, crisis by crisis.